Good morning. Welcome to another episode of Curious Investors. I hope your day has started well. I hope you're ready to learn a little bit something today, and I hope you're curious all the days of your life, because curiosity leads to opportunities, and opportunities lead to adventure. So today, I hope this is a little bit of adventure. The topic's a little bit mundane. However, the takeaway from today is the more you understand the taxes that affect you, the better you can respond to managing your resources around the rules pertaining to taxes. And today I'm just going to talk about the sorts of taxes that are out there and why it makes sense to pay attention to those so you can be better informed. But before we do that, let's jump into a quick series of disclaimers, because I don't want any of you to think that I'm giving specific advice today. So today, if you wish to remain unidentified from the recording, please remove your name and face from the view. This broadcast is strictly our opinions. This is an opinion-based show, and I hope you can enjoy the opinions and formulate your own. Stock investing includes risk, including fluctuation of price and loss of principal. Dividend payments are not guaranteed and may reduce or be eliminated at any time by the company. The following information is not a recommendation in relation to any specific security. Any references to specific securities are for illustrative purposes only. Content provided at this event is for general information and not intended to provide specific advice or recommendation to anyone. Any performance reference is historical and does not guarantee. Any economic forecast set forth during this event may not develop as predicted, and there can be no guarantee that any strategy will be successful. These thoughts and opinions are those of Gimbal Financial and do not represent those of LPL Financial. Any tax references are illustrations only. Seek advice of a professional tax advisor before acting on any ideas discussed. Securities are offered through LPL Financial, a member of FINRA and SIPC. Investment advice is offered through Gimbal Financial, a registered investment advisor and a separate, completely separate entity than LPL Financial. Got that? Are you guys feeling safe now that those disclaimers are behind us? Hang on and let your safety just be temporary, because we're going to talk about taxes, and taxes are not a safe place. Taxes are the government's way of trying to get their hands in your pockets. So what you can do is use zippers on your pockets and try to keep them out as much as possible. They're going to get some of that, but your ability to understand how the tax system works and manage your resources accordingly will keep more money in your pockets and less in theirs. I feel like everybody needs to pay their fair share of taxes. However, there are rules and opportunities out there that can help you preserve your capital. If you're not aware of those, you're going to end up paying more taxes than are really necessary. So let's jump into it. Today, I just want to talk about briefly the sorts of taxes that are out there so you can understand the magnitude of what really is going on. If you're earning $1, you're probably not going to have $1 to spend at the end of the day because of the tax man. First of all, we're all familiar with federal income taxes. Those are the taxes for which you pay to the federal government on an annual basis, generally required to be completely paid by April 15th of that year. So we're approaching the middle of March here in another week, and then we have a month after that before your income taxes are due. And so there's still things you can do in 2021 to reduce your tax liability for 2020, which that's partly up to you to educate yourself to understand those opportunities. And that's partly what I wanted to discuss today. As you invest, there's ways to invest more tax efficiently than otherwise. And just to have an awareness of that will help you accumulate more wealth over time. Let's briefly look at the idea of the federal income tax. The federal income tax is what we call a marginal tax rate, and a marginal tax rate is one for which the more you make, the higher the percentages that you're going to have to pay. And with that, that means that as you have growing success in whatever your aspirations are in life, you're going to feel the growing success of the government tugging on to you, because they become more successful, get more income as you become more successful. And so it's like each step forward you take in the success of your career, there's a partner with you that's not really doing any work on your behalf, but taking more of your money. And it feels almost like you're adding weight to a backpack behind you. And so that's what the federal income tax marginal rate does. And let me show you an example here that is near and dear to my heart. In 1984, I entered the workforce. I got a salary of $27,600 a year was my starting salary. I wasn't aware of marginal tax rates there, but let me talk you through the 1984 single tax bracket so you'll understand a little bit better how marginal tax rates work. So my salary would have been down in this range right here between the 23.5 and the 28.8. And so what that means when you're looking at marginal tax rates is the first money you make between $0 and $2,300, that $2,300 is going to be taxed at this 11% right here. And then the next 1,100 between 2,300 and 3,400 is taxed at 12%. What you need to understand as a taxpayer is that is not a 1% increase in taxes. What you need to realize is the difference between 11 and 12% is 1% increase, but to find out what the percentage increase is that you divide 1% by 11, and that's about a 9% increase in your taxes. Then when you go from 3,400 to 4,400, you have a 2 percentage point, and if you divide 12 into 2, you've got about a 16% increase in your tax rate. And so your tax rate is growing more significantly than you could ever imagine, and it's growing on smaller amounts of money. So what was going on with the federal government in 1984 was that the tax brackets were very small, and you just had what seemed to be incremental increases on each dollar you earned. And then all of a sudden, those increases, once you got to 10,800, they went from 18% to 20%, and then they started working their way upwards from there. And so when I was making 27.6, I was in the let me go back here. This is 0%. Your first 2,300 were taxed at 0%. I'm sorry, I had that backwards. But you then went to 11% and then to 12. So when I was in the 23.5 here, making 27.6, everything that I earned prior to 23.5 was gradually taxed at different rates. Each amount of money was taxed at a different rate, but every dollar I made over 23,500 was taxed at the 30% tax rate. Okay, 30% of every dollar I brought home, or 30 cents of every dollar I brought home, was going directly to the federal income taxes. Well, what happened if I got a pay raise from 27.6 and I made more than 28.8, I had another 4 percentage point, or about 11%, 12% increase in my tax rates, and basically a third of every dollar that I earned in my new pay salary would be going to the federal income taxes. So there's almost a disincentive to earn more money. Look what happened if somebody made $80,000 in 1984. If they made $80,000, every dollar over $80,000, 50% of that was going to federal income taxes. And that's what this is how the marginal tax rates work. If I go back and change this to the current marginal tax rates, and we change this to 2021, then this is how the marginal tax rates work now. For a single individual, your first $9,950 is taxed at 10%. Then between $9,950 to $40,000, you're going to pay 12%. Once you go above $40,000, your taxes almost double from 12% to 22%. So if you were making $40,525, and then all of a sudden you got $1,000 raise, you're going to notice a substantial increase in how much you're paying in federal taxes on that extra $1,000. It's going to be an extra $100 essentially on that. And so you've got that marginal increase, that steady increase in your tax brackets. But even at that, if you think about what I said, at $80,000 in 1984, you were paying 50%. At $164,925, you're still only paying 24% in federal income taxes today. the tax rates have dropped dramatically since 1984. My guess is we're going to start seeing those rates begin to stair step their way up in the months and years ahead. And that'll most noticeably probably be by them going over, the federal government going over here and putting extra steps in here. So there'll probably be something like a 15% bracket, and then they'll probably cut that range from 9,900 to 40,000. They may cut that to 30 and say 40 to 50,000 is 15%, and then they'll start just incrementally increasing that federal income tax. So that's what the marginal tax rates are, and that's how they work. If you have questions, feel free to call Gimbel Financial or call your tax advisor for more specific advice, and they can walk you through that. But that's where federal income taxes will affect your actual wealth accumulation and your pocketbook. Next, depending on the state for which you live, there are state income taxes. In Indiana, those are roughly 5% of your income. There's some deductions on both federal and income that can federal and state income taxes that will reduce how much your income you pay that tax rate on. And then you also will have maybe a local city tax on your income. In central Indiana, it's about 1%. So you're going to pay 5 to 6% in state and federal income taxes. If you live like on the coast, like in California, those state and local income taxes could be significantly higher. That's why a lot of people are leaving some of those bigger metropolitan areas where they local governments haven't managed their resources very efficiently. So you get your state and local income taxes. Then you also have state and local sales taxes. If you buy a car, you're going to pay a pretty steep dollar amount because of the size of a car purchase. You're going to pay a steep dollar amount in sales tax on that, which you'll see that deplete your wealth. And so just the idea of buying a more expensive car than a less expensive car for a young, curious investor, you're going to lose wealth right out of the gates because you're paying that sales tax. If you bought a $50,000 car and it had 7% sales tax on it, it's $3,500. Well, if you didn't have the money to buy the $50,000 car and you bought it over time, you're still paying that sales tax. What if instead of doing that, you just paid the $3,500 and that you'd pay in sales tax on that big car, and maybe added another $3,500 and have a $7,000 car, which is gonna be a fine car. You're just not gonna pay as much as sales tax on that thing. Local sales taxes here in Indiana, a lot of times those local sales taxes are more tipped on restaurant taxes and things like that, but you just have to pay attention to where you live and what those tax rates might look like. Then if you look at your pay stub that comes out with your paychecks, you've got what are called FICA taxes or Social Security and Medicare taxes. Those total for you at 7.65% of your income up until you hit thresholds for which you don't have to pay FICA tax or Social Security tax anymore. The Medicare tax goes on indefinitely. It's a portion of that 7.65. What you need to know about the 7.65% is not only are you paying that amount, but your employer is paying that on your behalf. So suppose you make $100,000, you're going to pay 7.65% of that, or $7,600 on that. So your employer is also paying $7,600 on your $100,000. So almost $15,000 of FICA tax is being paid to the federal government for your retirement income and retirement health expenses in the future. You're paying that. That's not given to you. You're paying it as you go. Then you have things like property taxes. Depending on the state for which you live, you're going to pay property taxes not only for the house that you have. If you own the building for your business, you're paying that. Locally in Hamilton County, Indiana, we pay property taxes for a business on the computers I have, on the headphones I have. I have to pay them a property tax on it, even after I paid the sales tax and purchased it. You as curious investors, as you're trading and making investments, part of what filters into your federal income tax is the tax called federal capital gains taxes. So the more successful you are in your trading, the more successful the federal government becomes. They are your silent partner who just doesn't care whether or not you make money, but they really like you to make money because they participate in the process with you. And so then the next significant tax is the estate tax and gift taxes that happened after your life ceases. So these are just a few of the taxes that are weighing you down and burdening your success in accumulating wealth. There's strategies that we'll talk about in Curious Investors that'll help you think through how to maneuver around these tax structures and how to make the most for your future. And those also are things that we can talk to you about individually. If you want to give us a call at Gimbal Financial, we can give you some suggestions on how to position yourself most efficiently as you look to the future. That's why some people use retirement accounts like 401ks, Roth, IRAs and such. And there's just a lot of avenues out there to think through as you make decisions looking to the future. But the main thing I wanted to encourage you is to stay on top of what your situation is, remain curious, and just smile as you look to the future. In the meantime, have a great day, and I'll talk to you all next week. Take care.